introduce Mike Brick coming up here to talk to us about his work at Earthshot Ventures. So, as we always do, feel free to chime in with questions as we talk with Mike. Thank you. Thank you for joining us.
Thanks for having me.
So I wanted to start with a little bit of your career through line and get to know how you got to where you are now.
Sure.
Can you talk to us about how you ended up or got to Western Group and what it was like there and what got you to the point where you were joining Elemental and now with Earthshot?
Yeah. For me, I've just always been interested in the environment. Ever since I was a little kid, I used to donate my allowance money to Greenpeace and places like that, just for some reason, very early on, just kind of obsession with animals and the environment. And got to college and did my undergrad and master's at Stanford, and decided to be an environmental science major. I was trying to figure out how to do that in a way that made sense, because what most people generally told me was, well, you probably become like an environmental lawyer, and then you graduate with a lot of debt, and Exxon will offer you a lot of money, and the environmental groups will offer you not very little, and you'll probably go work at Exxon. This is a terrible career trajectory. But then in college, came across clean energy as this real industry that was clearly going to be growing every year I was alive, and kind of had that epiphany of, awesome, this is the way to kind of apply this interest in the environment in a productive way. And ended up doing a startup right out of college, which is a company in the carbon offset market. At least 2 decades early to that market, maybe 3 decades too early at this point, we'll see. But selling offsets to companies that wanted to be decarbonized, individuals that wanted to do the same, and people lightly care. And then when the 2008 financial crisis hit, people really didn't care much about paying extra to be green. So kind of unsuccessful founder in that capacity. But then got introduced to a group of folks who were in the process of raising a venture fund at the time, which is a clean tech fund. Clean tech was kind of the big hot sector in Silicon Valley in the late 2000s. And so joined them as an intern and figured this is a cool place to just get exposed to lots of companies. I was intending to go to work at another company, and figured, what better place to just systematically be shown decent ideas to figure out where one might want to go. And just really enjoyed the process of looking across lots of different companies as I interviewed for the role and then started to work there. And after about 2 months, they made a full-time job offer for me to stick around. And so got to stay there essentially for 2 full fund cycles. So I was there for about 9 years. So investing the whole first fund, raising our second fund, and investing that whole fund as well. And the first fund was in the kind of era of really heavy industry, capital intensive clean tech stuff. So wind, biofuels, electric vehicles. We were fortunate to be investors in Tesla out of that fund, which allowed us to survive a lot of the pullback that happened in the space in the early 2010s. And then the second fund was way more software oriented. So just kind of a pretty broad mix of early stage to late stage, software, hardware, kind of all broadly across climate. I then left after the second fund and joined a place called Generate Capital, which is a project finance investor. So they would be the folks that would if you buy solar for your home now, generally you don't actually write a big check up front. Somebody else writes that big check to install the system, and you agree to buy the power from your roof for 20 years. All of it they can produce. Generate's one of the investors who would own that project. It's sort of an infrastructure investor in climate. Just a different type of money. Really interesting to see how when you're focused on solving a problem like climate change, venture capital is not the only type of money out there. It's actually one of the smallest pools of money out there. And it's a really, really, really specific type of pool. And if you are, so Generate was just an interesting way to see how other types of money work. And then I started to do some consulting at Elemental, which is where I met Jeff originally, and there worked with Elemental's companies as they went through fundraisers. So anywhere from raising seed rounds through much larger later stage rounds, and got to be kind of like the VC on their team, teaching them how to build their documents in ways of like, hey, here's what's actually happening on the other side of the table, the game of telephone that's going on, how to design your data room, your deck, and other ways to kind of increase your odds of success, help them negotiate through term sheets and things like that. And I loved that role. It was just a lot of fun getting to get really hands-on with founders, but also the thing that a number of people said to me was like, it's like you're a board member, but you're not on my board. And I like that. And I did too, because it just meant you get to just be kind of pure good cop. So had that role for a couple of years, and then in 2020, clean tech started to have another kind of resurgence. And probably a variety of different reasons why that maybe happened, but Tesla really exploded in the public markets around that time. Tech had done well for a while, and you had a lot of people leaving tech saying, sold enough ads, I'd rather do something worthwhile with the rest of my life. So a really interesting infusion of talent, infusion of new investors in the space. And so the folks at Elemental said, we've been thinking about doing a fund for a while. Kind of feels like now's the time. Do you want to be the person kind of spearhead putting that together? And so launched the fund with Don Lippert, who was the CEO of Elemental, and we're the two GPs in the first fund. We kicked off the fundraise. We decided to do this about 2 weeks before COVID shut everything down, late February of 2020. Sort of the last idiot in Disneyland before COVID shut everything down. And I think it literally closed like 2 days after.
Oh, wow.
So we kind of sat on it for a few months and then kicked off our fundraise in September, which turned out to be awesome timing. It was probably the best time to raise a climate fund in a decade. And we set out to raise $50 million. We ended up catching some momentum and raised about $94 million. And have been investing out of that fund. We're just right now at the tail end of that fund and raising our next one. So we've invested in 32 companies. We do everything from pre-seed, first money in on companies when we're, we've had a few companies that had to say, hold on, we need to incorporate before we can take the check. And we've done anywhere from there through Series B. We can lead, we can follow. Very flexible. We tend to be a little more opportunistic and say we want to find the best companies we can find and then figure out how to say yes, rather than, well, it needs to look exactly like this. I need to own exactly this percentage. I have to have a board seat, whatever it may be. We take a much more kind of flexible and opportunistic approach. And it's gone well. Fund's performing really well. And still early days, but excited about where things sit.
Thank you. That's exciting. And when you talked about the different types of money and the dynamic role that Earthshot takes, there's a unique relationship between Elemental and Earthshot that also can mix philanthropic funding. And can you talk a little bit about how those relate to each other, how they complement each other in different types of scenarios?
Yeah, so Elemental is set up as it's a nonprofit. It's an accelerator in the space, so it works with companies that certainly it hopes will scale, but it is thinking about climate and startups through the lens of how do I produce climate impact? Whereas we are looking at it from the perspective of how do we make financial returns. There's absolutely a Venn diagram of those two. One of Elemental's companies is Fervo, who had a very big IPO yesterday. So I don't mean to say that being focused on the nonprofit side doesn't produce those sorts of outcomes, but we approach it with a different lens. And so by having kind of two strategies operating under a kind of broader umbrella, there's a lot of commonalities that exist across the two. For one, some of our companies are the same. We have co-invested in a number of companies. The second is a lot of these companies need similar things. They need connections to investors. They need to hire interesting talent. They sell to utilities. They sell to large strategics. And so having a big network of companies, Elemental's funded about 160 companies historically. We've now done 32, so close to 200 companies across the portfolio. You have a ton of learning that can happen there. We try to think about ourselves as a venture fund less as, hey, I'm a smart person who's going to give great advice, and more as like a steward of a network. And networks are better at finding companies. Networks are better at evaluating companies. Networks are going to be better at helping a lot of companies. It's a little bit of lower ego style VC, I guess. But it ends up being kind of friendly, collaborative, and that style is one of a few different ways to be successful. There's also there's some sharp-elbowed investors out there who've been pretty successful as well. But at least our playbook tends to be kind of convener, collaborator, giver. Good things happen to folks that kind of approach the ecosystem with that kind of flexible give first mentality. So I guess hopefully a little bit helpful in terms of the approach across Elemental and Earthshot.
Yeah. We were talking before, and you mentioned, I thought maybe the number would be 400 or 500. When I was asking how many companies does Earthshot consider, or what's the intake volume like, and you said maybe over 1,000, 2,000?
Yeah, probably about 2,000 a year.
Can you talk us through a little bit of the stages of the due diligence process there, where some of the key decisions are made? I'm sure there are quite a few that are called right up front.
Yep.
Can you walk us through that stage?
Sure. We do two things. So I think one sort of unique part of Earthshot, it's not certainly not completely unique, is we do a lot of outbound, reaching out to companies, trying to figure out who we want to talk to. I think a lot of the mystique and what people sort of describe in ventures, the best companies come to me, I get amazing referrals of an incredible network. And certainly, Elemental, running one of the largest accelerators in the space, Dawn and I have both been investors in this space now for 17 years. She started Elemental the same year I joined the Wesley Group. We're pretty well connected. And about half the companies in our first fund have come through those referrals, and it's really valuable. It's the only way to find out about companies that are extremely early in their trajectory. It's in some ways the best ways to get access to really interesting companies, to get interesting referrals from who their investors are and such. But we do a lot of proactive outreach where in Fund 1 we, if you're rewinding for a second, when I was at the Wesley Group, a couple years in, we said, all right, let's do a little debrief. All the kind of companies let's make the list of the 10 companies we most wish we were investors in, but that we're not. And let's try to figure out why we're not in them. And I believe 100% of the companies, the answer was, we didn't see it. It was not we said no, it was not we said yes but we couldn't get access. It was we didn't meet with them when they raised that round, number one. And number two, it's pretty obvious that company existed. They had gone through a credible accelerator, they'd raised money from somebody interesting previously, and that kind of became a shame on us exercise, kind of conclusion from that exercise. And to me, that kind of then started to create this idea of, oh yeah, you can build up a database of a lot of companies that exist and start to pour through it and develop opinions about who you might want to talk to based on the team, what you learn about traction, who else is invested in them, etc. And so we kind of did that on steroids at Earthshot. We built an Airtable that just ingests information from a variety of different sources and buy data. We're able to identify founders in stealth mode, and it's a person who used to work at Tesla and now they're working on something new on LinkedIn. Yeah, maybe it's worth somebody just shooting them a note and seeing what they're up to. And that has now resulted in about half our companies in Fund 1, and it enables you to find ones that fit your investment thesis a little bit more, great. And I think we just end up being more aligned with those founders more broadly. There's a natural tendency amongst VCs. So we're like, oh, we're going to meet with another VC. Like, who in your portfolio is doing great? Who should we be talking to? And natural temptation to reach to the bottom of the deck, to the company that's not raising or not having a lot of success raising. Oh, I've got the great deal for you. Whereas some other companies that having no trouble raising, perhaps less actually likely to be referred. Obviously, there's a whole relationship dynamic there, but so we spent a lot of time in both. And then for us, we lean in terms of how we think about the investments we make in climate. We lean really heavily into thinking about playbooks, thinking about the sorts of businesses that have historically produced big financial outcomes. And there are some commonalities to them. There's a lot of them. It's not like, oh, they all have to look like X. But there are a number of repeat playbooks that we've seen work. Just easy examples of that are marketplaces. Marketplaces are producing the biggest outcomes of all time. eBay, Uber, you can make the argument Google, Facebook is a marketplace for your attention. And so where we see marketplaces in climate, get a little bit more excited. SaaS, probably a different answer now. SaaS has obviously changed a lot with AI, but when we started Earthshot, we did an assessment, went through the list of unicorns across tech and said, what is this company kind of thing? B2B? Is it B2C? Is it hardware? Is it software? And about 2/3 of them were B2B SaaS companies. And it's just like, now that's probably changing now. And it's really interesting to see where that's changed with AI. But at the time, saying, all right, well, if you're going to invest in climate or healthcare or anything else, if you're not doing any B2B SaaS, boy, you're either really clever or you're kind of missing some of the rules of engagement. So it makes this kind of weird type of money that's venture capital work. And so the last one, and we can move on, which is probably more relevant in the energy space, is one of the best business models of all time, which is owning a really valuable resource. If you look at the oil market, the reason there's tremendous wealth in the Middle East is because they own the oil. It's not because they're awesome at pumping it. It's not because they have amazing refineries. They do not have the world's greatest gas stations. They own oil. And when we think about extrapolating that into the clean economy, we think something pretty similar is going to happen with lithium, with copper, with some of these other precious metals. So we've made a number of investments around that similar premise. It's not my favorite analogy because it's like, follow the playbook of Exxon and Saudi Aramco. Or, as you might guess, probably not my two favorite companies. But they have been very successful at creating that major kind of concentration of wealth and success. And we think those similar analogies will play out in the clean transition. So when you think about them through those lenses, it becomes then easier to parse through lists and say, we'll certainly take meetings outside of some of those areas, and sometimes you'll learn about something new in a meeting. Our first investment was a company that applied a lot of the learnings from Moderna to the battery material space. And so Moderna was kind of our, especially coming out of having just gotten my shot. This was front and center at that time, but Moderna is built very differently from the pharmaceutical companies before them, which is how they were able to build the COVID vaccine in something like 72 hours after getting the first form of the virus. And so applying those same learnings to batteries was a really cool additional concept. So anyway, that's a little bit about how we think about the investments. And we're just kind of always kind of collecting and learning about just new businesses from outside and around, outside of climate, and where they intersect with it.
So that searching process, you obviously have a lot of volume coming in. I'm sure it's a lot of staff time, team time working on it. But it also brings up regionality, and it sounds like you go just about anywhere. That wouldn't necessarily be the way that every VC group would behave. And we're sitting in central Maine. I think by federal definition, most of Maine is qualified as rural. So all of us here are rural businesses. Can you talk a little bit about how companies starting in central Maine or in a rural area that might start to get the pull of feeling that I don't know if I'm going to get the type of investment or the type of financial support I need to get to where I'm forecasting I want to go if I don't move. Is that an old adage, or is there a new model in terms of how rural companies should think about their funding?
Couple points. So, one is I think it's, and this view is incredibly pervasive in Silicon Valley, is there tends to be this assessment of like, if I raise venture dollars, I have a good business, if I don't, I have a bad business, which is terrible, terrible, destructive. There tends to be a bias of, if I raise venture capital, I have a good business, if I don't, I have a bad business, rather than it's a really, really, really specific style. And I think investors, especially in climate, I think this has happened a lot, get in trouble where they use venture dollars for businesses that probably should be raising a different type of money. Those investments then end up going really well for the VCs. And then I think for founders, in a lot of cases, they just assume I have to raise that type of money. Maybe they beat their heads against the wall, building the business around, and with that dynamic, they maybe are more, I would say, one of the attributes of venture capital is you are trying to be a smaller piece of your pie. You're ceding control in at least over time. You're entering a trajectory of giving up much more of control of the business. It's rare that by the time a company goes public, the founder still controls the business. It might still be the CEO that whole time, but they've sold it off. They've sold off chunks of the business over time. For a lot of people that want to retain control, which is neither a good nor a bad thing, this is probably not the type of money you want to raise. And so one would be, I always really encourage companies to really challenge the assumptions around what's the right type of money that works for this business. Is it venture capital? Is it something else? Some businesses, it's just inherent. You're just going to need to do it. You need to raise a tremendous amount of money to have any sort of product. You're in a really competitive space where everybody's trying to climb to the top of a gigantic mountain. But man, there's a lot of great businesses that are built where people climb to the top of a decent-sized mountain and nobody else is trying to claw their way up it. And that's, I think, a pretty interesting option. So one, just generally caveats around that. Two, I definitely think the regional concentration, there are like two different weird dynamics at play. The first is that I think startup communities just do benefit from network effects. So when you're talking to founders, when I started my company in the Bay Area, talking to another founder who lived on the East Coast, and he's like, what? Lawyers defer the first $25,000 of fees just to work with you guys? And it's like, well, yeah, that's just kind of normal out here because everybody hopes, hey, maybe this is the next big thing. Unheard of for my buddy starting a company in New Jersey. Just an easier way to start a business at that point. Accounting firms, similar types of things. So all of this, investors that are nearby, your ability to network to investors, dramatically easier. As you grow and scale and the company needs a lot more people, you have a larger talent pool from which to draw them from. You need to grow for a really long time in the Bay Area before you get exhausted all the ranges of kind of people that you would need to bring into a company. So those are all, I think, very real advantages, and I think it's why you still have a lot of concentration of venture capital and startups in Silicon Valley. That's definitely changing, though. Everybody else is starting to create their own network effects, too. And I don't think that the network effects are in a way that create a winner-take-all dynamic. I think they're all positive stuff. So New York having a successful venture capital community, Boston having a successful, doesn't in any way erode the quality of the Bay Area. It's just getting up over an activation energy. So I think that represents an opportunity for areas that are outside of the major markets. And then the other two, one of which we've seen play out to some extent, and one of which we will see play out, Zoom's making it a heck of a lot easier to build virtual teams that, people are in various locations to access, hey, we've got this amount of core talent, but we need this specialty, we need to bring that in. That wasn't doable 30 years ago. And it's much easier to do now. And then AI, I think, has the potential to really change that need to hire more people. The need for there to be a whole bunch of people working on my business with all these diverse skills living near me. AI just simply changes for a lot of businesses. Well, this business can actually be pretty valuable with only a couple of people. Obviously, it depends on the type of business, but I think all of those will create a lot of fragmentation and enable people to build more better businesses outside of the major markets. And I generally just view that as like an interesting, positive sum dynamic. And as an investor, then certainly anything that is in the Bay Area or Boston, kind of in a major market that has some traction, pushes the price up, or pushes, makes it harder for you to get in, et cetera. So there's a lot of opportunity to be more expansive in where you look. There's a lot of, especially what we do in the physical world, there are companies that just it doesn't make sense to start that. Why would you start that company in the Bay Area? Start that somewhere where it's more close to the problem. So a company in Houston sells waste heat to power systems to kind of Houston and Calgary, sort of the Houston of Canada, but they sell waste heat to power systems that extract energy from industrial sites and produce energy from it. Way better to be building that in areas where there's a lot more industrial activity. Anyway, I think you'll see, I think we'll continue to see more activity outside of the major markets.
Yeah, it seems like you have to think about your region as what are the aspects of your region, the facets of where you are they serving you, are they not serving you, or is another area can serve you better? On some of those topics around grit, endurance that you have to see in startups to get through some hard stages. There are several companies in Earthshot's portfolio that took quite a while to get their traction. For all the companies in this cohort, they have a product, they have some customers maybe, they have a solid plan. There might be a prolonged process to getting the traction that becomes sustainable for them. Are there any indicators that you've seen or themes for some companies who are going out into the market, they've started to test and get their feedback from customers about when it might be time to pivot, when it might be time to change, because everybody could grit and endure it right into a failure.
Yeah, totally.
Yeah,
you're right. I agree with you on, grit is such an important attribute for entrepreneurs, but it does have the possibility of keeping founders kind of stuck on a particular solution. I think the way that I tend to think about it is you want to, as a founder, you want to be sort of obsessed with the high level problem that you're trying to solve and really flexible on how you're going to get there. So flexible on what that product looks like. But if you don't have that almost missionary North Star on the product, or the problem you're looking and trying to solve, it's hard to preserve that level of endurance and grit on the solution over that time. That doesn't mean that you don't build those plans for how you're going to get there. I really love the concept of the idea that you want to have strong convictions loosely held. So here's the plan, here's what we're trying to do, this is the game plan until we learn that it's not the game plan, and then we need to be able to quickly respond to that based on what we're seeing from customer feedback, an understanding of things like, I would say something that we see in the climate ecosystem a lot is people can be extremely focused on addressing the climate problem, which is of course awesome. I'm with you. but they're taking on too much. It's what you're doing would just require, kind of 7 leaps of faith, one after the other to get there, and this is just going to be really tough. Maybe you pull it off, but are there easier wins that you can accomplish? Are there, common thing that we would see is companies, for example, that there's a whole variety of companies that launch city by city. Think of Uber, think of Airbnb, many delivery services, etc. And you'll often see them say, all right, we launched in San Francisco, it's going great. Next, we're going to go to New Orleans, because it's nothing like San Francisco. And if we can do it in New Orleans, we can do it anywhere. It's like, damn, that's much harder than going to San Jose. Which is an hour south, same team can service it, same time zone, pretty similar, like build a culture of winning and success. And, kind of continue to push on those open doors rather than overly boiling the ocean, making it too complicated. That is an example of a company I was invested in that expanded too big, too fast in that capacity. And I think some of it was not just kind of leaning on some of those easy wins. So, I think grit can sometimes cause you to say, let's do the craziest thing possible and kind of prove we can get there. Whereas that combined with some pragmatism on building a culture of success, winning, you name it, ends up, I think, often working out a little bit better.
When that grit turns into hubris.
Yeah, totally. Yeah, there can be a fine line there.
We touched a little bit on it, but I wanted to go back to talking about AI. Several companies in this room are native AI or vertically. I want to talk about vertical defensibility. You have several AI native companies in the portfolio. When you think about what is the bar for defensibility around vertical AI, in 2 or 3 years, what stops a well-capitalized generalist from coming in and undercutting them? What is the current thought and analysis of those types of issues, especially in something that's evolving so quickly?
Yeah. I tend to think that some of the concerns on competition are a little overblown. As everybody knows, starting your business is hard, and there's a million things about it, a million roadblocks you run into that you need to persevere through. Certainly a business that somebody can vibe code your business in 10 minutes, sure, yeah, okay, I guess that's going to be trickier. But at the end of the day, if you have a team of engineers who have these tools and are working with 100 customers and iterating with those customers on how to make whatever that product is better, they're going to build a heck of a lot better product than me vibe coding the same thing for myself. Everybody kind of thinks of themselves as I know product. There's people who actually do in fact know product really well, and if you give them incredible tools, they're going to build better products than other folks out there. So one is, I do think that as you deliver value to customers, you'll find it's harder for folks to switch. I think some of those concerns are a bit overblown. Anything that has a physical world component, it gets significantly more challenging for some folks to compete with, especially when that physical component has a real moat to it. We have a couple computer vision companies. One that was actually just acquired, which puts cameras in aquaculture pens. So when growing fish in aquaculture pens, it's historically been, I don't know, throw some more food in there. Like, they have diseases? Not sure. Let's catch one and see. Think of this almost like the NFL camera, kind of zooming around in the pen, identifying individual fish, being able to correlate feed and medicine to outcomes, which makes those dramatically more efficient. Really hard for a couple of 24-year-olds to whip that one up in a weekend because of all the data that comes from being able to do that, iterating with different species, different locations, you name it. We have another company that puts cameras on utility trucks and it drives around and scans the physical infrastructure and says, here's where trees are encroaching, here's where a pole is broken and likely to fall over. In their case, one of their remotes, which is a remote they're making their way through themselves right now, is selling to utilities is really difficult. And once on the other side, that becomes some brain damage, and other companies probably less likely to want to follow, especially because somebody's already through that and on the other side. Some companies have a capital intensity to them, where investors are probably the biggest investment is a company called Cobalt Metals, which uses AI to identify, and this is back to the conversation previously on Exxon, to identify where do we think the copper, lithium, nickel, and cobalt deposits, where are they likely buried underground. Nobody's been looking for these metals in a systematic way historically. There's been a lot of efforts to find oil and gas. The major oil companies have spent a lot of money in that, but nothing about the conditions that create oil are similar to the conditions that would create a copper deposit. And so if you can ingest the world's data from geological data from a whole bunch of different sources and feed that to AI, might be able to be more predictive at finding where these resources are. They have now found their first deposit, and it is enormous. But that requires collecting a tremendous amount of data, a lot of local, hey, we've got a hypothesis on this particular area, doing a lot of test drilling, eventually buying mineral rights. All of that has a lot of barriers to entry. Again, a couple of kids waking up on a weekend. So that combination of a physical world component to it, a local component to it as well. I think there's going to be an explosion of successful local businesses that are, there's a small offline component, and I service my city doing XYZ really well. OpenAI is never going to come after that business. They got bigger fish to fry, certainly. And so I think people will build some pretty cool businesses on kind of local scale, being able to utilize these tools and make things possible that haven't been historically.
So want to pivot back to this cohort is getting ready for their pitch competition in exactly 2 weeks. We're in the Dirigo Raise sections, the third phase of the program over the 16 weeks. So we are at 14 weeks. We've been doing this for quite a while. And last week we had a speaker talking to us about trust and authenticity and how you're conveying your person and earning trust with investors or with partners, with customers. Take us into the other side of the room. I've come in, I've given my pitch, feel good about it. I walk out the door, clicks, and I start replaying my pitch in my head over and over again. What's happening in the room with the folks that I just pitched to? Is there an immediate process? Are there some gut feelings? What do you put us there?
There's both, and it's also important to recognize. I think the right way for companies and investors to think about each other is as peers. I think there's sometimes a bad dynamic where some VCs, we're the grown-ups in the room, and these kids would be lucky to work with us. The opposite can happen to companies. The idiot VCs have no idea what they're doing and whatnot. I think where that relationship is most constructive is when people think of each other the way they should, which is as kind of equal level peers. If you leave a pitch and it went really well, the investors are like, oh my gosh, what do you think they thought of us? I hope I hope we can get into that deal. They are having that level of excitement that you might have when you had a good pitch. They're living, a VC is living in a world where we invest in companies where they follow the power law. There's a couple of investments a year that are going to drive the overwhelming majority of the returns in our sector. And so we live in a state of paranoia that we're going to miss it. that you'd spend an entire year talking to 1,000 companies, and not one of them was even one of those companies. And therefore, all the activity that you undertook, evaluating, developing, all of that just didn't matter. Or you found it, you got there, you wanted to say yes, but you were a day late, or your idiot partner said no, or whatever it may be. So we had that kind of level of fear, concern, etc. There is certainly I think one of the key things in pitching investors is to recognize that there are styles of investing that are not totally clear to you, just different themes around, how I might think about companies versus another firm where you visit my website and their website and you'd say, I don't know, can't really tell the difference. But in reality, under the hood, we might think about things very, very differently. So one of the challenges in going through a fundraising process is it's hard to figure that out. And it's hard to know who was actually a good fit and I did or did not succeed, who was actually just a bad fit. And that pitch wasn't going to likely go anywhere. Who has invested in a company that kind of looks like yours in some way? It's in the same industry, or it has a similar, it's a marketplace. And boy, I made a lot of money in marketplaces before. My former firm, the Wesley Group, started by a guy named Steve Wesley, was one of the early people at eBay. Loves marketplaces. So marketplace companies, it's not on it wasn't on our website. We're a clean tech fund. Strong interest in marketplaces and a strong bias towards revenue. Because at eBay, they had revenue really early on. Revenue equaled profitability because they had almost no cost. And so that was a lens through which that would just kind of color the way that we looked at businesses. It's a great lens. It does cause you to miss certain businesses, though. A business that's much more technical, that's going to deliver a lot of technical value before it produces revenue, probably a harder one to get through that process. But we can give great examples of phenomenal outcomes in each. But those biases exist. We had an investment in a company in the trucking space that did not go real well. So, anytime another company that was selling into the trucking industry came in, and certainly at some firms, like, that company's not on the website anymore. And you don't even know that that's where some scar tissue might live. Much harder to get through that process. So, definitely, I think one of the key things for entrepreneurs when they go through a fundraise is you have to have a lot of thick skin. You have to be able to, I would always joke that the person who started the firm, one of the hardest working, most resilient people, especially in fundraising, I've ever seen in my life. And I would joke he could get told no, maybe, and be like, pretty good day. Whereas I tend to be like, you get the first probably, and it's like, nah, man, what are we doing wrong? We got to rethink the whole plan, but I don't have as thick of that skin. And it is a super powerful fundraising to be able to do that. It also then does suggest that there is a numbers game element of that around, because it's hard to predict who exactly is going to be that right fit. You do have to turn over a lot of stones. You do have to have a lot of conversations. You are going to have some annoying conversations with investors that go nowhere. And if you recognize that is just part of the process, you can't research your way into figuring that out. If you can approach fundraising with that mindset, I think you're more likely to be successful. It's less likely to get you down, as you inevitably are told no frequently. It's heartening to see these stories. Brian Chesky loves pulling up his rejection emails of trying to sell stock at Airbnb, and I forget what it was, a $2 million valuation, just the constant rejections that he got. So VCs don't get it right all the time either, and there's a great. If you ever check out Bessemer Venture Partners portfolio, they have a page which is their anti-portfolio, which are all of the awesome companies they said no to and why, and how humorously dumb it was for them to have said no. Like they're like, we passed on FedEx an incredible 9 times. We laugh eBay out of the room for Beanie Babies. Just kind of all of these. So they have, having some humility around it of, it's sometimes hard to figure out which ones are going to be the right ones. So it goes in both directions. So hopefully some helpful guidance on how to approach it.
Do you think it would be useful if I was pitching my company and I'm going out to pick who do I want to try and approach, to go look at different VCs, look at their portfolio, and try and develop a theory of the case of what are they thinking? Because those are pieces of evidence of trying to figure out where are those companies at the time. And maybe I can reduce my rejection rate by just trying to narrow down the folks who, the theory of the case that they're using to create their portfolio, and I'm over here. So this just isn't somebody I need to be talking to at this point. Okay, so going back to, you've had that discussion.
And maybe just one thing to chime in on it. So, of course, as a just spray it everywhere. The other really critical time to figure that out is at the very beginning of the meeting. So I think the best way to pitch investors is try to use that first 5-7 minutes of the meeting to understand what they're looking for, what a fit is, and sometimes you will just realize, I shouldn't be doing this, isn't going to go anywhere. But that also can be really helpful because it enables you to then approach the pitch differently. If it's not a fit, you can try something new. It's almost easier to think of yourself as a peer at that point because it's like, this company. I actually got my job at the Westie Group because I got introduced to a tech VC. I was like, this will be cool. I'll get my butt kicked in an interview. I started a company out of college, never really been to a real job interview. It was clear about 5 minutes into it. There was no way I was getting this job. But then just kind of hit it off with the guy at the end of the meeting. He's like, I know a clean tech VC you're hiring. You're obviously a way better fit for them. Why don't you see over there? And so that can be an opportunity. But then the second is, for almost any business, there's probably 2 or 3 ways you can tell the story. There's, I think of like the slides in your pitch deck as being like beads on a necklace. And yes, there's a certain number of beads that need to exist, your competitors, your team, your market, your margins, all those things. There's lots of different ways to weave those together. And I saw this firsthand with one of our founders, who's just an exceptional salesperson. They sold the utilities. We had a large utility who was an investor in our firm, and they were interested in talking to the company. And he just spent the first 10 minutes or so just asking questions about the utilities business and where their challenge points are and where they're leaning. And it was pretty clear he knew, like, I have 3 ways to sell what I'm doing here. And I'm going to get you to tell me which way to sell it in the first 5 minutes of this pitch. And so thinking about it in that dynamic lets you then deliver a better pitch versus, nice to meet you, Mike, cool, let me get going. It helps you understand fit, it helps you sell it better, it helps you understand not a fit now, maybe a better fit later, shoot, would have been a fit last round, perhaps not this round. So using those first few minutes to try to tease that information out is really, really valuable.
Excellent advice. I'm going to stop my questions on that point and open it up. Anybody? Catherine from 7.
Thanks so much for being here. This is really helpful. Can you give us maybe a typical profile for a company in that pre-seed stage? And like what kind of traction are they showing to make you interested enough? You mentioned, you're talking to people that are still in stealth. So what does that look like? Maybe what are they targeting in terms of raise and that stage?
Yeah, so, at a pre-seed, we're usually not looking for any traction. We are looking for, it's usually that, founder who's willing to just like, all right, I'm going to break through that wall, and you go through that door, and I'll race to the other side. That is an awesome attribute. You're also looking usually for complementary co-founders. We've done, I guess, like one true like sole founder business where they didn't have at least another very strong, very early executive. And often, people are pretty different from each other. I think some of the most interesting companies come when you are not, the flaw of my business that I started was I started it with one of my environmental science classmates. We were roommates, best friends, in a band together, and dating roommates. It's like, that's the exact wrong person to start a business with. We were good at the same things, we were bad at the same things, we enjoyed the same things, we disliked the same things. You want people who are really different. And so we really like when we see, an example, one of our companies in the forestry space, they sell software to groups like CAL FIRE. They were trying to manage California's fire risk. The company was started by a forestry expert and the chief product officer of Netflix. So somebody who doesn't know anything about forestry but knows a ton about user experience, building scalable software teams, and where the two of them can come together and become obsessed with a problem set and addressing it. Really interesting, kind of strange combinations. At the very earliest stage, also, what we just tend to, like the question that we ask a lot, and we think the companies have to have a really awesome answer for it in that kind of, again, venture capital, kind of pure, one or two companies is going to drive the vast majority of our returns, is the question of what can go right. And I think venture capital is the main asset class. And if you're doing mortgages, who cares about what can go right? I need 98% of people to pay their mortgage. That's what I need. If you win the lottery after I lent you the money, I don't make another nickel. You just become one of the ones who are probably going to continue to pay your mortgage. But in venture capital, it's the opposite. It's only that kind of tail benefit that drives it. And so that's why we think about playbooks, but also why we just think about like, what would it take for this company to see a really substantial outcome? And at the very earliest stages, that's what so much of our, and even frankly, later on, that's kind of the question we find ourselves obsessively thinking about. It's helpful to have somebody who has been sort of a student of that market, a student in some cases of that playbook. We're building a marketplace, and we have some guy who built a marketplace in some other industry on our board because they can help us think through that better. We're also looking at, we're not a huge firm. We're often co-investing with others. We do have to care about who else is investing in the company. Maybe at the very earliest stages we can take that risk, but especially as companies get to Series A, Series B, we don't have a big enough fund to say, I don't give a shit what anybody else thinks. I'm going to support it because we're not big enough to do that. If we had a $2 billion fund, I could say, I don't care, like I'll trust my instincts entirely. But there is that kind of collaborative aspect that somewhat plays out. And then also from an investor, back to the complementary founders, it's also really helpful when you have complementary investors who like companies for different reasons. So my background is all in climate. If I see a deal and let's say it's an enterprise software company, and they have 5 climate VCs in it and no software investors, that makes me nervous. Because it feels like, if you're evaluating a house, it feels like we're all standing on the east side of the house and what's beautiful, what's awesome. I'd much rather somebody stand on the west side, the south side, and the north side, all saying from their different lenses, hey, I'm an enterprise software investor, love it from that perspective, I don't care about the climate. You like it from a climate perspective, somebody else who's got an expertise maybe in the customer segment that they sell. If you can bring those disciplines together, I think the company tends to probably be better if it can convince all of those people. And then the company gets the gift of really complementary networks and really complementary value add to what they do versus just a bunch of people saying, I can make the same interest rate.
Aside from the obvious capital, what can a venture capital firm bring to a startup? And subsection of that question is, does that differ if you have a board seat from not?
So lots of different ways VCs can be helpful. So some is being a sounding board, kind of bringing the experience of having done it a lot before, some commonalities, sharing, hey, my bias, I had a call with the company the other day, and it was just, they were describing a plan of how they were, not pivoting, but like another market that they were expanding into. And I had a lot of concern on that market, because I've seen a lot of companies struggle selling in that market, and just offered reasons why, offered ideas of how to get around it, offered perspective on how to approach it from a conservatism versus aggressive perspective. I think that can be useful to companies. Helping founders navigate disputes is a big one, because it happens, and enabling people to work their way through those disputes. I mean, as a VC, you do not want to replace founders. It's exactly. It does not usually go well when the teams don't get along, the CEO isn't going well. That is usually, it's not what the VCs are trying to make happen. They want the founding team to be in there, getting along, to scale, etc. with the business. Customer introductions can certainly be an area. Investor introductions can certainly be an area. Helping people remain self-aware. And I think it's important for VCs to be, but everybody tends to be good at certain things. They can be less good at certain things. The more that you can lean into your strengths, you're going to be happier, you're going to be better. There's lots of things, especially with entrepreneurs, you tend to be interdisciplinary, you tend to be successful in a variety of different areas, but you do want to figure out how to focus and specialize and really capture what is your, at a very early stage, being really generalist is very helpful. But as the company grows, you actually want to hire somebody who's way better than you at finance to be your CFO, and hire somebody who's way better at operations to kind of run the team on a day-to-day basis, or sales, or whatever it may be. So I think that's a really key area. Brand is also, like, kind of lending a brand is also just something that, Anderson Horowitz kind of describes it as like we become we give companies power. By working with us, you have this brand association that makes it easier for you to get certain customers, easier to attract talent, easier to raise that next round of funding. Because if a company sends around their pitch deck and, hey, Sequoia led my last round, they're going to find it quite a bit easier to get that next, at least a meeting with the next investor. So that brand association can really be it's hard to build up. It's hard to build up over time, or it's hard to build up immediately, but something that kind of grows over time. But can really be something that really helps founders. And then lastly, I'll say an area that we've leaned in a lot is this the kind of peer-to-peer network of founders. You all have this here, which is really valuable, with the Elemental network alongside Earthshot. It's 190 companies. There's former founders in there that come to different events. There's a CEO summit that happens every year where people get together and really learn from one another. I'm sure you remember the circles of needs and offerings, where people will go around and say, all right, I'm raising my Series B, and I need intros to potential investors, and I just went through SOC 2 compliance, and I'm happy to offer perspective on how to do that for anybody who's going through that process. Right? And the next person's like, we're just about to do SOC 2 compliance, but I've got this other, so I need that, and I've got this other challenge. But that community and ecosystem can be really interesting, helpful, and valuable thing to help companies, but only some of those require you to be on the board. And we have tended to approach board seats in a pretty flexible way because I just generally, I've witnessed personally, there was a time when I was on the board of a company called Interchem, which is building a large industrial facility. They took municipal solid waste and converted it into biofuels, building a huge chemical plant. The board was full of people who built chemical plants before. Awesome board. And I joked I was as useful as a tape recorder and significantly less reliable. At the same time, I was on the board of another company that was going through a major pivot, going through a founder transition, co-founders transition, and was able to just be I was the youngest person on the board, more the kind of age and peer of the CEO, and so was able to just be that personal sounding board, so in one context, the right person at the right time, the next day going into a board meeting and being totally useless, and just determined that as an investor, I want to invest in the best companies. If I think that also means I'm always the right ideal person for every one of the best companies, one, it probably requires an ego I'm not prepared to have, but it's also probably not right. That it's often helpful to say, we like this company, what they need are the following things, which I can't provide. And so I'd rather there be a board that I'm not on that's providing that. Or in some cases, what we've started to explore doing is to say, especially as companies get larger, you got 5 investors on the board. The incremental value of your second and third and fifth investor on the board is pretty low relative to saying, can we bring in another operator, somebody who has sold to companies in this space, who's really well connected across your customer base? That person's going to be a much more effective board member than your fifth VC. And so we started to work on, can we give our board seat to somebody else? So we still own the board seat. If there's a contentious vote, we can still tell them how they might vote on that. But on a day-to-day basis, that other person's probably going to be more helpful. So having that humility in terms of how to approach companies, I think ends up making them more effective.
I know we are past time, so you've been very generous, and I just want to let people know, feel free to go if you need to. I saw, Noah, your hand first.
Yeah, thanks for your
Sure.
time. Appreciate it. You seem really playbook oriented. You mentioned kind of elite sales processes you've seen in regulated businesses to slow-moving enterprises. And I was just kind of curious what you, and beads on the necklace kind of analogy is really helpful in terms of storytelling. Just wondering if you could dive deeper into some of the techniques you've seen working really well with sales along in this kind of project.
Sales techniques that work in what specific environment?
Well, you mentioned with the utilities company,
Yeah.
But in general, regulated businesses where there's a burden of accuracy and a brand that seems to also couple and relate to what we're doing in terms of pacing. It's not one person, it's a chain of a large organization all having a good process.
Yeah.
Someone who's strong in that.
So one most important thing is just recognizing that's probably how the process is going to go. So a thing that I saw in the first wave of climate investment sentiment a lot was, so smart grid was kind of one of the hot sectors in the early 2010s. And people say, we just got a pilot with PG&E out in California. It's a $250,000 pilot. We're going to be huge. Let's go raise $50 million, hire 50 people to scale this up. Great news, PG&E could be a $50 million customer. Oh man, is that not what's about to happen? It's going to take longer. There's going to be strange nonlinear movement through that process. I think that the point that people repeatedly make about utilities in particular is that they're terrible prospects, but they then eventually become incredible customers. And so one key takeaway certainly is recognizing there's probably only so many, only so fast that you can push that process. And be careful around burn, be careful how much you raise, recognize that's part of the reality of the situation. A second is figuring out how to get in the door in some way, so you are starting to sell them something. There is a lot of that challenge is often for some larger regulated businesses. Transitioning from they pay you nothing to they pay you something might be half the battle, and then going from something very small to something significantly large is the other half. But actually crossing that first chasm isn't actually that hard if you can figure out how to build something that has no competition, maybe shifts risk in an interesting way towards you and away from the customer. One of our companies ended up, so they sold to utilities. They did have a very light, so they originally were a fast follower of an existing company. It looks for the company O-Power in the utility space. They went public in 2015 or so. Sort of kind of an O-Power Me Too. It was like, a better mousetrap to utilities, and ultimately concluded utilities don't care about a better mousetrap. They just needed a mousetrap. And this mousetrap is the credible brand mousetrap. We don't care about your better mousetrap. So they pivoted, built a different product that had an incredibly low price point that got them in the door and had kind of interesting attributes of it. What then happened with the business, which took it to a much more dramatic scale, was they and another company combined as part of a private equity roll-up because the company that we were investors in had a couple of key utility accounts. The other company that they rolled up with had different couple of key utility accounts. And all of a sudden you had the complete set by combining the two of, top 8 or so utilities logos. Then they went around and acquired a bunch of other companies that had a couple $1 million in revenue, kind of failing to scale, but cool product, needed that access. And all of a sudden, now because you had all these different logos under one roof, you can start to cross-sell the products. And they found that to be really easy, exaggeration here, but a lot easier to do. And so the company was able to scale much more significantly. So one of the things I've also encouraged some companies to do is to look into, sometimes there's like a little bit, as your company grows a little bit, sometimes just a weird little business that you can acquire that actually, we sell this like little accounting offering to, this market, but man, we've got, it's a tiny little product, but look at the logos. And it's a way to kind of sneak your way in the door to then be able to provide some of that upside. So those are maybe, I don't know if I answered your question, but maybe a couple of the strategies we've seen. And then hopefully just over time, it just gets easier. People are able to look at, okay, these folks purchased it. Yeah, we can get comfortable. There's certainly a lot of who's done it before, want to be the first to be second. Utility case, probably the first to be fifth. It can kind of feed off of itself. But I think those companies tend to have a trajectory that's probably a little bit flatter earlier on, and then has the ability to scale more quickly a bit later.
Josh, I saw your hand.
Yeah, and briefly, thank you for being very generous with
Sure.
me.
Yeah.
But you've mentioned, or you sort of pivoted a couple times. You talked about loose convictions,
Strong conviction.
strong
Yeah.
And when that pivot comes up, or when it's apparent that what the path you're on is not the scale you thought it was, or maybe it's the wrong direction, and that pivot happens, what's that process like between the company and your entity, and what's that conversation like,
So one thing that sometimes or often a key thing that like the term pivot means a real pivot. It is you're going for this direction and you are changing. And one of the places that companies, I think, often struggle is they don't really pivot. You have the board who's complaining that they want to pivot, but the company hasn't made a pivot. Or you have one founder who thinks something's going wrong and the other isn't really bought in. And so I think one of the most important parts of doing that well is truly doing it, and there's this concept of disagree and commit, where maybe we don't get along, or maybe I don't think this was necessarily the right decision, but we're making it now. And so you're either on board with moving forward and being constructive towards the decision that's happened, or you need to get off the boat. And that can be hard for investors often. Sometimes it's a time where it's actually really important to have a board vote on stuff, where like the structure of a board, or depending on how you govern the business internally, having an intentional, at this time we're going to make a decision. And what that can be pretty helpful in is, let's say one of these VCs wants you to make a pivot, and they're complaining about it or whatever. Great, let's put it to a vote. You just lost the vote. Stop complaining, stop talking about it. This is how the thing works. And somebody who's not able to say, all right, if new things come to light, let's have another vote. But sometimes that formality of decision making and really making a decision versus talking about making a decision, thinking about making a decision, debating, talking about making this, all of that is, I think, is a really dangerous place to live in. And the sooner that you can make that transition, and again, do it with it, and that's sort of a strong conviction, still loosely held. We're pivoting to this other thing. We're making that change, I think, is one of the most important parts of that process. And it usually does involve, because we've made this transition, these people at the company aren't maybe the right people to be working here anymore, or we need this new skill set now that we don't have. We've got to bring that in. The board that we have and we've assembled isn't quite the right people anymore. Sometimes the CEO isn't the right person to be running that new type of business. So there is it's pretty rare that it's everybody's on board with the pivot, and it turns out we have the exact right people now that we've completely changed the direction of the business. That's unlikely to be the case. It's unlikely that 100% of people are on board with it. That's where I think like leaning into the kind of the wisdom of the governance structure, being more formal in those parts of the process, I think often, like I find when things are more contentious at companies and stuff, I usually encourage the CEOs to like go read Brad Feld's Startup Boards book again, here's how boards work, here is the there's a lot of wisdom in how the system is set up. When things are going well, or things are fine, board meetings can be a little more casual, etc. When things get more contentious, and I think there's a lot of value to preserving some of those structures, even when not in more troubling times. But kind of being more intentional, being more formal, I think can often be one's right, and being kind of formally making decisions in particular.
Thank you. Sure.
Oh, go ahead.
Sure.
Yeah. Mike, you are like the oracle of truth. So I really enjoyed, but the one tidbit that you mentioned, I think it's worth expanding on, was that co-founder dynamics.
Mm-hmm.
And we have, we're doing a raise, I think you probably know, and we're working with consultants. And one of the consultants was like, we're going to make the team the first slide.
Yeah.
Because they were because my co-founder and I are this, but also in the same direction. And they felt that was the most compelling thing about our whole business, is that the founders.
Mm-hmm.
And I've been in I've worked with other founders, and the best one founder was Israeli, and we would yell top of our lungs at each other.
Yeah.
And then we'd go into the meeting, and then times that we pitched benchmark, Tel Aviv, and it was like, everybody was yelling.
Yeah.
And then we had lunch and got money, right? So, but like, I can't imagine pitching without a co-founder present, and I also can't imagine pitching with a co-founder that just is on the same page at everything.
Yeah.
And I'm just curious if you could elaborate. That's my intuition.
Uh-huh.
I do pitches, I don't listen to pitches, and I don't evaluate the pitches.
Yeah.
So I'd like to hear the Oracle's view.
Yeah. So one thing that I started to do at Elemental, which I really highly recommend, is most startup founders only see other startup founders pitch in an elevator pitch, which is not how anybody raises any money, right? The way an actual pitch works is you sit down for 30 minutes, 60 minutes, and talk through a full story. And so giving founders the ability to see somebody else do that and say, oh man, your slides make no sense. Or like one of the most common issues in pitches is you get 10, 12 slides in and you're like, I do not understand what this company does. I understand kind of the market they're in, who works here, some problem, but I don't know what they do. And then you go back and look at your slide and you're like, yeah, mine doesn't do that either, does it? And so one awesome exercise that I would definitely recommend is just having sessions where somebody gives an hour-long pitch and have a VC in the room. I could do this sometime. But mostly have their peers around the table. And the value is more for the peers around the table, to not the feedback they're actually going to give the pitcher. It's the, oh, I see, my eyes glazed over. I also started checking my email 8 minutes in when I didn't realize what the company did. So I think that is one particularly useful exercise. On the question of what slides should go where, I definitely do not think there's an order of which slides should be where in a deck. I think there's some general rules about, I'm very not religious on how many slides should be in. And people are like, oh, it has to be 15 slides. That's horrible advice. I think for certain businesses, you need 3 slides on this particular thing. Some businesses, competition is not really relevant. It's like, yeah, whatever. Like, for this particular offering, that's the least of my concerns. For others, it's the whole bet. In the former, you could probably get away without even having a competition slide in your deck. For the latter, you might have 3, 4 slides because it comes with every darn pitch, and it is important of how do you interact with it. What I generally encourage founders to do in terms of putting together their pitch deck is figure out how you want to tell the story. And do that without slides. How do you, if you're going to explain to somebody how your business works, you understand your business, and the most important part of the pitch is your arc of the story. And when you take, and that's hard to do, and you should iterate like crazy on it and figure that out. But I would do that, and then figure out how slides complement that. Figure out what blind spots maybe exist. I do need the competition slide. But one of the biggest dangers that then happens is when you start to get feedback from people, and they say, you gotta move your team slide up here. Why do you have 3 slides on competition? Everybody knows you need to have 1. And what they're doing is they're messing up your arc of the story. And so, of course, you want to figure out how to incorporate useful feedback when people can provide it, especially if you're getting common feedback from investors on, I really do need to beef up this section because I get the same sets of questions each and every time. But the most important thing in that is for you to be able to be a storyteller. And if the deck just turns into this robotic, I'm supposed to do this slide and that slide, but they don't flow together correctly, I think you're in for trouble. And I would say the one thing I would aim for early is, what do you do? That is something that, like, if you just take 12, 15 slides, yes, people's eyes are going to glaze over and they're going to stop thinking about it. They can't put all these other things in context, like, you're showing the competitors, but I don't even know what you do. You're showing the market size, but I don't know what you do. So that my one bias on timing is very early on in the and it could be very, maybe 10 words. Make this product, and it's like, what product do you sell to who? Then you can walk through, why does it matter, who's the team, and why are they relevant, etc. Team is a good one. It's usually very early or towards the end. It's early when the team is going to jump out at people. If you are Elon Musk starting your next company, you're probably not going to put that at slide 20. It's probably going to be number one. When you're me and my buddy starting our company out of college, definitely shouldn't be put it at the end. Because that's probably not the reason why people they're probably going to bet on the idea there rather than the company. But mainly just get good at telling your story and do that without a deck. And then let the deck complement that story.
I will say the last pitch we did, we emailed the deck.
Yep.
But we didn't refer to it or use it at all.
Yep.
For the hour. Just being like,
Yep.
just chatting.
Yep, and sometimes that works great. Sometimes one of the challenges of that sometimes is if people will just start peppering you with questions that you've organized a linear story, and so it can work. It can also go, like, I often when our companies come back to pitch us for a follow-on round, I've seen frequently that be too casual. And, we invested in them 3.5 years ago, and some colleague is new, or they barely remember what the company did, or they pivoted a little bit. And so for those follow-on conversations, I generally, the guidance I usually give companies when they're coming in to pitch to the rest of the company is, don't be too casual at that. Remember that you got to bring people along on that journey, reestablish why this is interesting, at least a little bit. But yeah, when it can be that give and take, it's more of a peer dynamic that's happening there, right? When it's more conversational. So I think when that works well, it's kind of the best way to do it. But it sometimes goes pretty off the rails.
Kevin?
One more quick one. Just maybe as a recommend positioning that aspect, because I do have a board of advisors, I have some early team members. There's ways of like showing the team, but I don't have co-founders.
Yeah, that's it. I think being able to highlight other complementary disciplines around you, whether that's advisors, board members, key team members, they don't need to be co-founders. And then it also just depends on the business. I think some businesses more need it. Like if you're building a company like Cobalt, which is AI and geological sciences, it's like probably want to see one of those two people, and somebody that's good at each of those two disciplines on this deck. Whereas something that's perhaps less weirdly interdisciplinary, and I'm not thinking of a great example right now, it's probably less important. I think one of the things that I certainly have recognized in the companies I've worked with, the founders who feel obsessed with finding the best people they possibly can and getting them into the company, even if they are too senior, even if they might be threatening to their job, this person could probably take my job. I hope the VCs don't figure that one out. But people who are secure enough in that and talent aggregators in that just tend to be really successful. And so I think being able to communicate that around, I'm trying to bring really interesting people around me, this is what I'm good at, that hopefully is nicely aligned with what this business needs to be good at. Because lots of things you can be good at, and in any market, it's like it's probably one thing that's more important to be good at. But another is just for certain areas. Let's say it's a more technical founder who's less strong at sales. Kind of communicating that you are just like obsessed with becoming good at sales. I'm reading these 3 books, and I constantly listen to podcasts, and like being a student of the problem that is maybe your weakness, because I want to hire the best possible VP of sales in this or whatever it may be, is I think a strong positive tell to investors. But I think doing it in the context of not I'm the best person at every darn thing, but I'm good at this, and here's how I'm. The lawyer of our startup has said, like, the best founders surround themselves with people who are better than them at complementary disciplines. Just like a really good, pithy, like, got it, okay, yeah, shit. So looking at my co-founder, you look like me. You're very similar to me in so many ways, and fortunately, we're still really good friends. So it all worked out. But yeah.
Well, thank you so much, Mike.
Sure. Appreciate it.